Hello everyone. In our previous videos, we learned about the basics of mutual funds and how they work in India. Now comes the important part, the types of mutual funds. Now if you go and browse through the internet about the types of mutual funds, you'll find a plethora of mutual fund types. This can be very confusing for new investors as each type of mutual fund has distinct features and is ideal for different types of investors. However, by the end of this video, you will be having a much better understanding of how these mutual funds are segregated. So, we understood how the fund managers of mutual funds invest in a wide range of securities to generate returns for the investors. Mutual funds are classified into multiple categories based on the types of securities in which the fund manager will be investing and the investment style of the fund manager. This provides a variety to the investors to choose the best suited fund type for themselves. However, all these categories can be broadly grouped under three main categories, that is equity, debt and hybrid. Now let's start with equity mutual funds. Think of equity mutual funds as a thrilling roller coaster ride that is full of ups and downs, but it takes you to heights if you remain seated on the roller coaster. The reason why I'm denoting them as roller coaster is because these funds invest majority of the funds in equities or share market. The fund manager will be selecting the stocks after thorough research and analysis and will be actively managing them. Based on the type of stocks the fund manager will invest and the investment style, equity mutual funds can further divide it into multiple subcategories. The most common types of equity mutual funds are large cap, mid cap and small cap mutual funds. Now some roller coasters can be more thrilling than others, while some can have fewer ups and downs. Each listed company on the stock exchange has a market capitalization that defines the size of the company. As per SEBI, the top 100 companies are classified as large cap companies. From 101st to 250 are called mid cap companies, and all the listed companies after 251st rank are considered small cap companies. In a large cap fund, a minimum of 80% of the corpus will be invested into large cap companies. The large companies are generally the market leaders in their respective industries, have significant experience in the market and are financially stable. Hence, they generate stable returns, or we can say there are fewer ups and downs in this type of roller coaster. However, it is also important to consider that the return generating ability of these funds is less than mid and small cap funds, as these companies are already at their peak and have a smaller margin of growth from where they are. Mid cap funds are bound to invest at least 65% of the corpus in mid cap companies. The mid-cap companies have a decent experience in the market and are less stable than large caps but have slightly higher margin of growth. A small cap fund invests more than 65% into small cap companies. The small cap listed companies can have wider margin of growth and have the potential to become bigger companies in the long term. Hence, the return generating ability is highest in the small cap funds, but at the same time, risk in these companies is also high as they are less stable and have less experience in the market compared to large and mid-cap companies. For those who want the mix of all three categories in their investments, there is multi-cap and flexi-cap funds that invest the corpus in large, mid and small cap companies. The only difference is that multi-cap fund is bound to invest 25% in each of large, mid and small, while a flexi-cap fund can have any proportion into the three categories of stocks depending on the market condition. Another category is large and mid-cap funds, in which 35% is allocated to large as well as mid-cap stocks, providing a blend of growth and stability to the investors. A dividend yield fund invests across all types of equities that are dividend yielding stocks. In a value fund, the fund manager follows a value investment strategy targeting the undervalued stocks. A focused funds can have a maximum of 30 stocks in the portfolio. In contra fund, the fund manager follows contrarian investment strategy. A sectoral or thematic fund is a type of equity mutual fund in which all the stocks in the portfolio belong to the same sector or theme, like banking, pharmaceuticals, IT, etc. ELSS or equity linked saving scheme is a tax saving mutual fund scheme. Think of this as a roller coaster with tax saving twists. It has 100% equity allocation and is one of the Section 80C instruments that allows investors to reduce their taxable income by Rs 1.5 lakh per year. It is the only equity scheme that has a lock-in period of 3 years. We will be learning more about other types of mutual funds in the next episode. Until then, stay curious and keep learning.
Mutual funds are subject to market risk. Please read all scheme-related documents carefully before investing.